everyone. Welcome back to The Lens, hosted by Larry McDonald. This week, we're going to discuss the AI disruption, and for that, we brought in the most special guest you could see on our show, AJ DeRosa, CEO and founder of Intellibox, a very successful leader in the startup space recognized for strategic vision, execution, and driving sustainable growth. Guys, go ahead. Ready to hear you.
Thank you, Valentina. Appreciate it.
Yeah,
It's
thanks, Val.
it's great to have you here, AJ. This is, with your background since 2012, 13 in artificial intelligence, you're the perfect guest to talk to right now. With your fintech background and the AI background, you can see in the financials today, lots of disruption. The financials are underperforming the S&P 500 by to start January and February by almost the most since 2008. It's a very unusual year. Through January and February, the consumer staples are outperforming, and that's recession-resistant equities are outperforming the S&P by 15%. That's also extremely rare. Markets are speaking, ladies and gentlemen. Hold on. Markets are speaking. How to listen markets speak. We're going to get into that right now. Jose, let's get through the slides. I'll whip through them. But markets are speaking. When you see the financials underperforming the S&P 500 by this much, KKR down 30%, Blackstone down 30%, Bank of America down 8%, with the S&P flat on the year. So Bank of America is underperforming the S&P by literally almost 10%. In the fintech space, we clearly have disruption here for MasterCard and Visa. We're going to get into some of the kind of points behind that looking forward. Jose, I want to whip through the slides fast, but you can see there the underperformance in the financials. Big components of the XLF right here, which is the financials ETF. Next one, Jose. And here, once again, so we run a Bloomberg chat with hedge funds and mutual funds and pension funds in more than 20 countries. We started the conversation in 2010. It's an incredible platform because we can talk about what's happening in the markets today with the best and brightest credit and equity investors, foreign exchange investors in the world. And one of the things that people are talking about this week is CLO equities, which we just showed there. CLO equity, which is a component, it's a kind of the mezz piece of collateralized loan obligations, but that equity tranche is underperforming big time this year. Once again, that's 2008 like. I'm not saying it's 2008, but that's definitely 2008 like, massive underperformance right there in the CLO space. And that's something that has to do with software disruption and artificial intelligence kind of starting to impact the credit market fairly dramatically, especially in the loan space, not so much in the high yield space. Next one, Jose. As you can see here, the HYG, I just looked at the drawdowns, the BKLN, which is the bank loan index, off almost 3% this year. So your leveraged loans, your bank loans are much more exposed to software and credit risk coming out of artificial intelligence, whereas high yield doesn't have the same type of software exposure. So the HYG, which is your junk bond index, markets are speaking here. The loan market's not in flames, but it's in pretty, first, second, third ending of pretty serious stress. Whereas the high yield market, we haven't seen a spillover there. Markets are speaking here. We think this is going to spill over to high yield in the weeks ahead. As you can see there, triple C's a lot higher in yield than they were when the market was at all-time highs last year, leaking wider, leaking higher in yield. So, but once again, we haven't seen a major contagion from loans, which are in some serious stress, over to triple C junk bonds. Markets, always remember, markets are speaking. Credit leads equities. As an equity investor, you want to keep an eye on credit markets because credit markets typically lead equities. We talk about this in our book, How to Listen to Markets Speak. Next one, Jose. Okay, once again, in the financials, the XLF is your financials ETF. like I said, underperforming the S&P 500 by the most in a long, long time. And you can see down the bottom here what's really causing it. You know, your Blackstones, your Capital One's down like 18% year to date. Like I said, KKR. So you get a lot of KKR's down 30, 40%. So your financials that have exposure to software disruption from artificial intelligence, you can see that's where the pain. Whereas you can see on the top of the screen, some of the banks are actually unchanged on the year, like Goldman and U.S. Bank Corp and alike. So the pain really is in certain parts of the financials that are definitely more exposed to both the consumer, like Capital One, and artificial intelligence. And Capital One, and look at American Express there as well. Next one. And XLF down. Some of the banks today are down 5%. As you know, in 2009, we came up with our New York Times bestseller, A Colossal Failure of Common Sense, the inside story of the collapse of Lehman Brothers. The book's been published in 12 languages. It's one of the best business books ever written, according to the CFA Institute. A Colossal Failure of Common Sense was about the financial crisis of 2008. I wrote the book with Patrick Robinson. Special thanks to him and James and the Robinson family. As you can see here, once again, credit risk in hitting the financials fairly dramatically this year. You broke the uptrend, and once again, financials underperforming the S&P by the most in a long time. And once again, you've got the financials underperforming the technology sector, which actually the technology sector is actually down year to date. Everyone knows there's a lot of pain in software names. They're down 20, 30, 40%. But as you can see here, we're underperforming on the financials versus big tech by almost COVID levels. That's, once again, something you might see in the 2008 period. Next one. Now, Workday, we're getting it. You can see here with some of the software names, we're seeing some clients starting to buy software versus short, what we call the semiconductors, the SMH. Some of the software names, we're getting a category 5, a really high capitulation score in some of these software names. And as you saw today, the big conversation in the chat, Jack Dorsey laying off 45, 50% of his workforce. Now, I'm telling you right now, when you see Jack Dorsey make a move like that, he's ripping off the Band-Aid. He's ripping. He's basically, he could have laid off that part of the workforce over the course of the next 6 9 months. He's taking the pain right away. And the question is, how many other CFOs are looking at this move right now? Block equity, XYZ equity is 30% off, higher above the February lows. So at the end of the day, the market is rewarding Block and Jack Dorsey for firing close to 50% of his workforce, close to 50%. And that means that other CFOs around the country are thinking about the same thing. When you see block equity up 30% off the February lows, because the CFO is taking a drastic step. And at the end of the day, if you read the transcript of what Jack Dorsey said, these are blood-curdling words. He's with AI agentics, which AJ is going to get into. AI agentics, he's able to get the productivity out of 3 employees what he used to with maybe 15. And so this is massive disruption. It's coming into the bond market. Look at the SOFR futures. Look at the SOFR futures. One of the things we have a model, very important model. We have to listen when market speaks. When you see the SOFR futures, and all this means is bets on rate cuts. When you see the rate of change at that speed there, which is very fast, we track the rate of change of rate cuts and SOFR futures. And you're looking at 26 versus 27. A lot of rate cuts have been priced in. And by the way, today we had a hot PPI number. It barely affected, like normally you get a hot PPI number on inflation. Rate cut expectations should have changed the other way today. But instead, the rate cuts, because of the contagion coming in from software, because of that credit risk, we're getting more rate cuts coming into the market. And hot inflation should have caused rate hike expectations to actually increase. But no, it's that credit risk coming from software. Some of the clients in our chat, we run the best, I think the best Bloomberg chat in the world with hedge funds, mutual funds, and pension funds. We love the Bloomberg terminal. One of the conversation pieces is April, May, June, we could see 100, 200,000 job losses in the United States from software and disruption. And that's something that everyone's talking about. And here you can see software underperforming these semiconductors by the most all time. That's an 11 weekly RSI all time record. So software is in a lot of pain. And once again, you have to ask, when you see Jack Dorsey laying off 50% of his workforce in one day, other CFOs in the software sector might be thinking the same thing. That's going to hit the job market April, May, June, most likely. We have to look forward, not backward. And here you can see the pain in the software sector as a whole below this week, below its 200-week moving average. Pretty rare thing. We only saw that in 2022. Next one. Next one. Thanks. And once again, high yield, you want to look for contagion from the loan market to high yield. We're seeing a lot of stress in loans, a lot of stress in CLOs, CLO equity, collateralized loan obligations, what we call securitization. There was a securitization conference in Vegas this week. I spoke, a number of our clients were there. They said it was probably the most down, the most stressed out people have been in a long, long time in the CLO space, in the loan space. Remember, loans have a lot more exposure to software risk and disruption. And that's one of the things you're seeing starting to leak over to high yield, Anybody that wants to be in our trade alerts, reach out to info@thebeartrapsreport.com, info@thebeartrapsreport.com. We've been hosting calls in the fourth quarter on business development companies, on BDCs. We've been way out in front of this for our clients. We've actually been shorting the financials since the fourth quarter because of this contagion from BDCs and software leaking over to the financials. But Jose, I think that's enough of the slides. Let's kick it off with AJ. So AJ, tell us about your business and disruption and your career and what you think is really going on.
Yeah. So just a little context on my background. As you said, I spent about 18, 20 years in technology focused on finance. So financial technology as far as I would define it. And in about 2013, I decided to kind of leave that space because innovation was not doing what I thought it could do anymore. A lot of private equities happened, mergers and acquisitions. So I was introduced to AI, and I entered the AI space in about 2013. This is when, the GPU was just starting to be researched and utilized in computer vision and machine learning and all the AI that was out there. So I got involved at that point before the GPU was even utilized in an effective way, frankly. And I've been there through 2026, and I've seen this evolution of AI that is extreme. It is grown exponentially, and it's incredible in many ways.
And what's your take on what happened with Jack Dorsey and Block today? Because I want to talk about your company, but I also want your take on what happened today.
Yeah, I mean, I would say, look, AI is very, very good at doing tasks, right? It's very good at taking a lot of administrative things away from work from humans, and I think that is the optimistic piece of it, right? But it also is why there's going to be this transition, right? That's happening very quickly of these tasks being taken over by AI in certain cases, and then transitioning that workforce into other areas. But I think we're going to your point, we're going to see a little bit of that happen in the near future. But over time, I think the transition will be to different types of jobs as well. But humans can do three things really, really well: aspire, create, and set goals, right? AI cannot do that. They're going to continue to need us to do that. And I always say humans lead and AI scales. So any place AI can utilize to scale productivity, people are going to put that to work.
And if you think about it, I mean, the AI moment was, I guess, fourth quarter 2023. So we're at the point now of potentially a massive disruption point where it starts to impact the labor market. And if you think of CFOs seeing Jack Dorsey laying off 45, 50% of his workforce, and then all of a sudden his stock is up 30%, you have to think that other CFOs are looking at AI agentics and saying, okay, maybe we can actually work with less employees and get higher productivity.
Yeah, I mean, look, you're the finance guy, so you're better to analyze that and approach that. But what I would say is, one is got to make sure that whatever they're doing is working, right? And making sure that they're getting the product market fit, that whatever they're doing with the agents with regards to AI is working and it's actually giving them the lift that they believe they're getting. Coming from that side of the business, I would believe that is what's happening. They are getting the lift, and they are getting the lift in productivity. But I also think that opens up the ability with agentic AI to really create an entire new economy and workforce of people being able to start their own businesses and do things in a hyper local perspective. Now that's going to take some time, right? So I think
Yeah.
to your point.
So let's talk about Intellibox. So what you have is a revolutionary, game-changing technology.
Mhm.
If you think of all the financial advisors in the United States, right? Hundreds of thousands of financial advisors. A lot of financial advisors have moved to independent shops, left the wirehouses, now are getting a higher payout. Intellibox, that disruptive technology where you're actually allowing a broker dealer to have a customer facing platform that can do the job of many employees. Is that, tell us about the disruption that's coming at us?
Yeah, so I think the disruption is coming at us, and from the RA perspective, wealth advisors or what have you, is a little different in the sense that the RAs and wealth management space is actually shrinking, right? And the transfer of wealth is increasing, right? So there's this huge gap with regards to the ability to manage about $100 billion in the next 5 to 10 years. So technology is actually needed to be able to scale these wealth managers and wealth advisors in a way to be able to handle all of that transfer of wealth. What we do on our side from an Intellibox perspective is we've created an agentic AI platform that can take a lot or all of the administrative work off of the desk of the wealth managers, so that way they can be more human. Things like compliance, financial planning, research analysis, and making sure that the agentic operating system itself can collaborate, so those agents can collaborate with one another as well as with the advisors. In addition to that, and more importantly, is from a wealth management perspective, what we've seen is typically a wealth manager speaks to their clients maybe once or twice a year to reestablish goals, and maybe digitally touches them once or twice a month. When you're on Robinhood, you're on Robinhood 9 times a day, right? So there's this gap that needs to be closed from an engagement perspective. So part of the agentic platform that we created at Intellibox also has client engagement. So it's a B2B2C in the sense that we can actually, we create a platform that the advisors can then hand to their clients so they can see commentary, they can see context, they can see transparency, they can see things like this that you're doing today on an ongoing basis in order to keep them engaged and also keep them educated and involved. So I think the disruption that's going to be happening.
It's kind of like your own production studio for your clients, right? So you could have,
right.
So you can have commentary, you can have real engagement. And to your point, one of the points we make in the book, there's almost 80 trillion of wealth. 80 trillion. It's going to move from the boomers, Gen X, to all down to millenniums. So the next generation is going to inherit all this money. And to your point, the next generation, the younger people, are on the Robinhood app is so much more interactive, right? And they're getting much more interactive connectivity, whereas the older generation is not getting that. And so you want to be out in front of that trend shift.
Yeah, want to be in front of that. I mean, the younger generations definitely are more technical, and they're more engaged in investing, and they want to be involved in that. And I've got a 28-year-old son who texts me every day about investment stuff, right? And his cohort and all his friends are the same way. It's not that they're investors, but they're interested in this stuff, and they want to be engaged, and they want to be part of how their money grows and more involved in that. So I think going forward, wealth managers and wealth advisors and anybody within the advisory industry is really going to need to figure out ways to be able to engage with their clients more. More importantly, as you engage with your clients, if you have a platform to do that, now you can also give prospective clients the ability to see kind of your commentary, your context, the education that you're giving your clients, and also gives you the ability to also increase, from a business developer's perspective. But at the end of the day, what technology is going to really be able to do for wealth managers and wealth advisors is typically what it would cost them to scale their business 10 times today. Technology will cut that by 10%. To 10%, right? So if you were going to spend $1 million or $1.5 million on hiring new people to go from $1 billion to 10 billion, right? Now you probably spend 250 to 300,000 with technology to be able to do that and scale in that significant way. So I think that's the most important thing about what technology is going to do for wealth management. Again, different. You're seeing some of these organizations that are scaling the employees down and replacing it with the AI that can do the tasks. I think in places like wealth management, you're actually going to see additional hiring as well as huge scaling because of the technology that AI is going to bring to the table.
Right, exactly. And so that's the thing about this year is the financial sector is being hit by credit risk from artificial intelligence on the software side. You got companies like Expedia being disrupted in the travel side, C.H. Robinson. So it's definitely spread. The credit risk is spread from software over to other sectors. And in the financial sector as well, there's a number of companies that are being disrupted just in terms of customer service, like Schwab, for example, LPL Financial, the way they engage their customers. Get into some of that. The way how is AI going to change that customer relationship in terms of that engagement?
Well, I think what you're going to be able to do is really be able to answer high level questions in a more meaningful way, and you're able to answer questions 24/7. Right? You've got the NASDAQ NYC that are going to 22 to 23 hours a day at some point, right? So if you're an advisor like LPL or something, you're going to need to be able to answer questions on that time frame as well. But from a customer service perspective, AI is built for that, right? The ability to answer questions immediately. That doesn't sleep. It's got no healthcare, no 401k, right? And it's always on. And you can also direct it in the way you want it to answer, and you can keep it within its parameters to answer the questions that you want it to answer. And then when you feel that you don't want it to answer that and you want them to get involved with the live person, then you can have them involved with the live person as well. So you've got the best of both worlds with regards to customer service, because you get the high level questions answered, so that way the humans can actually answer the hard stuff and be involved with the clients on those things, which actually increases the customer experience, not decreases the customer experience.
Right. We've got thousands and thousands of subscribers to the Bear Trap support all over the world. And Valentina and the team looked at all of last year's incoming questions, and 35 to 40% of them were repeats over the previous 4 years. In other words, an AI agentic model can handle the questions and be more interactive. But if you get the same question over and over again, that's something that AI can really handle. So what we're going to do, we're partnering up with Intellibox, where you're going to be able to come to the Bear Trap support, get all your research in one spot. You can look back in history and say, okay, say the natural gas names or uranium. We've had a big call on uranium since 2021. What was the research product saying over the last couple of years? You can get all of the commentary, all of the trade alerts in one place instead of emails and chasing out WhatsApp and all these other. I think that's what's happening, right? The interaction between human beings and between a company and their customers is been in several different places. And when you're talking about what's Intellibox really going to bring to the table?
Yeah, I mean, especially with regards to with Bear Traps, with what we're doing with you guys, is the aggregation of all that data into one, easy to use application that all of your clients can go to, whether it's a mobile app or a desktop, and be able to see all that information, comment on it, and have the same interactions they have with you today, without having to go to Discord, to email, to WhatsApp, to text, and so the other things. And I think that goes for many or a lot of research firms out there, as well as wealth managers, right? And the wealth management advisory space, is a lot of fragmentation. I was just on a call before this doing a demonstration for a wealth advisor where that was their biggest concern. Their concern was, my clients have to go here, 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 and here to get this information. I really want them to go to one place. And oh, by the way, I also want them to be able to go to that place to be educated on what I'm thinking, get some more transparency and context of what I'm thinking, and be able to communicate with me in one platform. And that's the other piece too here. It's really important that as part of this is the communication stays within the platform. When we built this from a domain expertise perspective, from a wealth management perspective, an RIA for RIAs and wealth managers, advisors, and research firms. So compliance and regulatory are really important to us, right? As we built this thing out. So keeping that communication within one platform, so it's audit trailed and archived, is going to be really critical. I mean, texting people while you're a wealth manager, advisor, or within the broker dealer and thing is the no-no, right? But if you have a platform that's audit trailed and archived and has compliance wrapped around it, then you're in a safer place where the SEC comes to knock and you at least have the information that you need to be able to show it more readily. And then you take into account LLMs and what's going on with LLMs and them utilizing information to train on. You need platforms like Intellibox to make sure that that information is being protected, that PII is being protected, and it's not getting outside of the four walls of that organization. Because I think people are going to have a pretty interesting wake-up call when they realize that some of these LLMs are still training on their data, even though they're enterprise level applications.
Right, and the one thing that I'm really the debate so we run, like I said, we run that Bloomberg chat in the Discord room as well, and so there's say let's just say there's 650 people or so in there. There's maybe 50 people that are part of the active conversation every day, and the big debate is over the valley or under the valley. And what I mean by that is when something comes in like a COVID or like an AI disruption, the over the valley look is positive, Pollyannish, and there's a lot of truth to it. And all that means is you're looking over the valley, over the downside, to the other side, and you're looking at, oh my God, companies in the drug space and biotechs, they're going to be so much more productive, right? And so much more profitable. And like you said, everything you talked about on the financial side, a financial advisor's P&L, at least his profitability, is going to go up much higher because he's going to have a more productive relationship with his clients with less potential internal costs, right? So there's all of this upside, this over the valley. But under the valley, the question is, are we going to go under the valley or over the valley? I think some of the best traders that I've been listening to this week that I've known for decades, they're really looking at the disruption first. And that is the period of unknown in terms of, right now there's 30 million people that work in the software space. Just that one sector, 30 million people. So if you look at something like a Block and Jack Dorsey laying off 45% of his workforce and his stock's up 30%, I'm thinking in the next couple of months, it's going to create a great opportunity because that disruption, that uncertainty creates an under the valley thing where that disruption creates opportunity, creates a big drawdown in the stock market. It creates, the market has to figure out the winners and losers. That's going to take a little while. It's a little bit like when Lehman went down. We wrote about this in my first book. When Lehman went down, it created a fog. You couldn't see. You didn't know who the victims were. It took the market 4, 5, 7 months, almost a year to figure out who are the victims. It's the same thing today in a different way, not as severe, with AI. We don't know who the victims are. We can see the markets telling us CRM's a victim, Adobe's a victim, and a lot of the software, but now that's starting to spread to other areas and it's created more fog. That's what we're looking at today. But AJ, we're up to 29 minutes. Thank you so much. We're going to do another series with you and David LaPlaca and the Intellibox group. Any closing comments you want to make?
No, look, I just wanted, Larry, thank you for having me on. I really appreciate it. We're looking forward to working with you with our partnership and making sure that your clients have an exceptional experience. And, I look forward to working with many other wealth managers and RIAs as we continue to grow the business. So thanks for giving me the opportunity to have this chat with you. I appreciate it.
Excellent. Thanks, AJ. Thank you, Valentina, Jose, and the rest of the team in New York, and Robert, and everyone. All the best.
Thank you, AJ, for joining us. Thank you, Larry. As AJ mentioned, we just started this partnership just a few weeks ago, and I cannot stress this enough to you guys. It has been a pleasure working with such an impressive team. So, if you're interested in learning how to use this platform and also having the best investment research for you, reach out to info@thebirdtropsreport.com and we'll be more than happy to host you. As Larry mentioned, we run an institutional live chat on Bloomberg. We have more than 600 investors in more than 23 countries, and we're waiting for you to join us. So do not hesitate to reach out info@thebirdjobsreport.com. Many thanks for joining us, and we'll see you next time. Bye.